Namaste, good morning. A session on commencement of capital gains, a standalone chapter in terms of questions also. It can be instead of clubbed with a what a comprehensive question. I don't deny that they club with a comprehensive question. They can also have a standalone question on capital gains. Uh, because to club this with other arenas might become little difficult for the examiner, or if they want to question in depth they might ask for a standalone question in capital gains. So PGBP or IFOS can be easily clubbed with other chapters, but here for example PGBP will have deductions, capital gains will not have deductions. The mode of computation of tax itself is different for capital gains. So considering all these things, I would say that this is a standalone chapter question. Well, what is capital gain? What is the basis of charge? Okay, what is capital gain? In the last class opening, I have told you what is gain. Gain is surplus arising from isolated activity. Surplus arising from one time or isolated activity is known as gain. So capital gain, surplus arising from isolated activities of capital transactions. Might be sale of asset, might be sale of business as a whole, which are very rare. From a perspective of individual, if we talk, leave alone those who are doing in share trading, etc. From a perspective of individual, I would say that his tax paying age starts from around 25 and goes for up to 58, etc. So some 30 years of in his span, once or twice only he might have touched upon this chapter. Sale of land and building, sale of jewelry, like that. So that's why it is a very rare transaction chapter, not a very dynamic transaction chapter. So gain, which is of capital nature, which arises due to capital assets, right? Section 45 says any gain arising from the transfer of a capital asset effected during the previous year shall be chargeable to tax under this head after providing for lot of things which are there in 54. Though the law says 54, it is 54. So it's a plural terminology, not just one section in 54. There are 8 sections. Okay. Any gain, so we know it's a gain arising from transfer of capital asset effected during the year. To tax an income under this chapter, the capital gain should have been transferred during the previous year. To tax an income under this chapter, the capital gain should have been transferred in the financial year for all of us 21-22. We saw the same terminology 8 classes before. We saw profit and gains of business or profession carried on during the previous year. And then we said there are some exceptions to this rule, like bad debts recovered even after closure of business, fees recovered even after quitting of profession are all taxable in this. House property, the house should be there to tax it. But exceptions are arrears of rent received, or unrealized rent received after the house has been transferred is taxable in. So every chapter, though they say that it has to be during the previous year, but they always provide exceptions. So this affected during the previous year has its own exceptions. Okay, this affected during the previous year has its own exceptions, my dear friends, has its own exceptions. Though we are going to see those things. Insurance compensation on destroyal of a property. Destroyal is the transfer event, but taxation event is not the year of destroyal, the year in which compensation is received. Compulsory acquisition by the government. Compulsory acquisition is the taxable event, but the is the transfer, sorry. Compulsory acquisition is the transfer, but the taxable event is the year in which you are receiving the compensation. So, transfer of capital asset effected during the previous year. Not necessarily all time it should be during the previous year, but majority of the cases shall be chargeable to tax under this chapter after providing for exceptions. Yeah, if the payment is received in parts, first time when you are receiving, you will pay the tax. Yeah. Coming back. Any gain from transfer of capital asset. The two most important terminologies are transfer and capital asset. It should be a capital asset. It should have been transferred. It should be a capital asset, then it should have been transferred. This is the key words of this chapter. Okay, to come under this chapter, to tax under this chapter, it should be a capital asset, and that capital asset should have been sold or transferred by me. Transfer is a larger terminology than sales. Sales is a smaller terminology. Transfer is a larger terminology, right? Let's start with understanding what is a capital asset. Property of any kind held by the assessee, whether used for the purpose of business or not. Repeating. What is a capital asset? Property of any kind. What is a property? What is a property? Land or building used for business or personal purpose, one of the answers. What is a property? Used for more than 1 year. One for அதுக்கு வரைக்கும் property கிடையாது அது. What is a property?
Tangible assets.
Tangible assets.
Something which you have a title.
Something which you have a title.
Ownership.
Yeah, got it. Not acquired within? Not acquired frequently is a property. Okay, right. The vehicle you came, is it a property? And the Kannadi property, yeah? Yes. Watch? The pad, the calculator, the pencil, the pen. Huh? Everything is a property. If I ask you a question, what is a property, you can ask me what is not a property. Actually, the terminology property is so huge. Whatever you possess, you own, is known as a property. Whatever, our friend said, based on title deeds. Title deeds little bigger, but anyhow, I'll take that answer. Everything is a property. House property the explanation, land and building opportunity. Here, property, and they are not only stopping there, property of any kind, any type of property. Wait, I'll come. I'll come to your answer. So when I asked you all watch vehicles, pen, calculator, refrigerator, television, everything is a property. Property of any kind. Held by the assessee. The terminology held means ownership. Always in law, whenever they want to tell you that you should own, they will use the word held. Held by the assessee, owned by the assessee. The property might be a business property or not, or a domestic one. So the definition opened up in a big manner saying property of any kind held by the assessee, whether used for the purpose of business or not. And then they will close saying, however, does not include. Initially, they opened up the definition so big, and then they are saying, however, it will not include the following. So, property of any kind held by the assessee, whether used for the purpose of business or not, is a capital asset. Couple of years back, they said, if a foreign institutional investor holds security, it is a capital asset. The interesting part is, even though they are going to own it as stock in trade, it is a capital asset and the income is taxable under capital gain. Huh? Regardless of time limit. Yeah. Any security held by FII which has been invested in accordance with SEBI regulations. Okay, more about this we will see in non-resident taxation when we do FII. Now, however, it does not include stock in trade. Okay, raw material, consumable stores, spares, etc. Stock in trade held in a foreign portfolio investor is a capital asset and gain arising is capital gain. So as our friend said, regardless of anything, this is capital gain. We will see that. Movable personal assets. Movable personal assets are not capital assets. Now if I ask you, your vehicle is not a capital asset. Your television, refrigerator, okay, are not capital assets because it comes as an exception. All personal assets, movable personal assets are not capital assets. Okay, for example, assets used for domestic purposes. This does not include immovable property, obviously land and building, jewelry, work of art, architecture, painting, etc. Okay, those are capital asset. Okay, if we start with it does not include, and again use the word this does not include. Exception is taxable. Okay, exception is taxable. Mathematics calls it as negative into negative is positive. Okay, so assets used for personal purposes, movable assets are not capital asset. However, work of art, architecture, painting, jewelry are capital assets. Rural agricultural land is not a capital asset. Friends, rural agricultural land located in a rural area. Agricultural land located in a rural area is not a capital asset. And law defines what is urban area. Law defines what is urban area. Suppose there is a municipality or cantonment board having a particular level of population. We'll see that. The law say in all directions, aerially they are measuring the distance, which means they believe Google Maps. Okay, from in all direction up to a particular stretch, it is a urban area. Beyond that, it becomes a rural area. Okay, okay, look at this. Where the population of municipality or cantonment board is more than 10,000, less than 1 lakh. Okay, take a municipality or cantonment board. What is that population? Let's take 80,000. Then up to 2 kilometers, it is urban area. Beyond that, it becomes a rural area. Any agricultural land located in the rural area is not a capital asset. Population more than 1 lakh, less than 10 lakhs. Up to 6 kilometers, it is an urban area. Population more than 10 lakhs, up to 8 kilometers, it is an urban area. What is the question? Within 2 kilometers, it is an urban area. The land there is an urban agricultural land, taxable if you transfer it. Okay, beyond 2 kilometers, it becomes a rural area. In that area, if there is an agricultural land, then that is not taxable. Rural agricultural land depends upon two criteria: distance, a population of that municipality or cantonment board, not the population of that area, population of that municipality or cantonment board. Up to what kilometers it becomes an urban area. 1 lakh to 10 lakhs, up to 6 kilometers it becomes an urban area, and 10 more than 10 lakhs, this is the most popular, up to 8 kilometers it becomes an urban area. Gold bonds, special bearer bonds. Gold bonds, special bearer bonds are not capital asset. Are not capital asset. Read through once what is a capital asset. Is the screen freezed? Aranganayaki?
No, sir.
Am I clear? Am I clear? Okay, right. So these are not capital asset. As if we have been given a very big exception the government is putting to us, but it is not. But it is not. Stock in trade is not a capital asset because in the previous chapter you are taxing it. If you sell stock, you're getting profit. Tell me which of your movable property will give you capital gain? Do you think that if you sell your vehicle, you will get capital gain? You will get loss. And they don't want you to set off against the gain. So how to avoid it? So this is not at all capital asset. Do you think that your consumer durables will fetch you capital gain? Jewelry will fetch you capital gain. They are taxing it. Land and building will fetch you capital gain. They are taxing it. Work of art, archaeology will give you capital gains. If you have an antique, etc., they are taxing it. So whatever will not give you gain, they are accepting and saying, look, our law is very generous to you. Movable personal assets are not capital asset except a few things. That few things only you will get gain. In all other things you will get loss. If you get a loss, you can set off against gain. How to avoid that? This is not at all capital asset, sir. You cannot tax agricultural income. The union government does not have the right. Rural agricultural land. Majority of the transaction itself will not be known there. Okay. So if you think that we are giving a better benefit, okay, I want to tell you that no. Okay. Not that these are benefits available. These are exceptions by default. Not exceptions by their choice or generosity. These are exceptions by default. Okay, right. The next question is, what is transfer? What is, because the second is, one is capital asset, second is transfer. What is transfer? For understanding that, I have already told you, sale is a very smaller terminology, transfer is a very larger, wider terminology. So transfer involves lot of things. Sale, exchange, relinquishment. Sale, transfer of ownership and possession is known as sale. There should be transfer of ownership as well as possession. That is known as sale. Exchange, barter system. Relinquishment, giving away a right. Relinquishment, giving away, taking away your right. You are an existing shareholder of the company. The company comes out with fresh issue saying, for every 2 shares, you can subscribe for 1 share. You are not interested in subscribing. You have a right to subscribe for shares, which you are not interested in subscribing. You are giving away the right to someone else. You are not transferring shares. You are transferring the right to subscribe for shares. Relinquishment. Company's law calls it as renunciation of rights. Relinquishment. Okay? We can say examples like this for renunciation, or I can just tell you that watch all climax movies of Talaivar movie. Okay? Talaivar relinquishes 3,000 crores Ettinger. Okay? Relinquishes. Huh? A relinquishment. Okay? நான் தலைவரை பத்தி கிண்டல் பண்ணலாம், நீ பண்ணக்கூடாது. Okay? Relinquishment. Okay? Right? Next. This is where from here there are interesting things. Extinguishment, destroyal of a property. Destroyal amounts to transfer. Yeah, insurance compensation is okay. We'll come to that. These are, don't worry, all these cases individually we are going to do. I'm just giving you a bird's eye view. Extinguishment means destroyal of a property. That is also regarded as transfer. If a property is destroyed, Supreme Court in Vanya Silk Mill case said there is nothing to transfer. The property itself is not there. Why are you taxing it? Okay, so it is not regarded as transfer. There is always a bigger problem between judiciary versus administration. So you rub salt on their wound, they will immediately amend the law, saying extinguishment is also a transfer. And said, okay, so extinguishment is a transfer. Conversion of asset into stock in trade. What people did, said stock in trade is not a capital asset. Okay, then we will do one thing. For namesake, I will start a firm, a real estate firm. Transfer my land to the real estate firm and then sell it off as stock in trade. Conversion of asset into stock in trade is regarded as transfer. Is only voluntary transfers a transfer? No, compulsory acquisition by the government is also transfer. Redemptions are transfer. Okay, this is popularly, you will see that in our practical world as transfer through power of attorney. To avoid stamp duties and double transfers, power of attorney through POA transfer allowing partial possession. Okay, and for a member of a cooperative society to whom housing property is allotted, he becomes the deemed owner of the property if he transfers. So remember, the terminology transfer is very wide. Sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of asset into stock in trade, all types of redemptions are all transactions, okay? Are all transfers, even partial possession. Conversion of preference shares into equity shares. Is it transfer? Why? No more, no gain, etc. Is conversion of preference shares into equity shares transfer? I'll come to know the answer later, but the answer is yes, for two reasons. Though later I'm going to say it is not regarded as transfer, but two reasons. I want you to understand, that's why. One, it is the exchange. You are giving preference shares and getting equity shares. Second, as he was telling, it is a relinquishment. Preference shares means preferential right of dividend, preferential right of repayment of capital at the time of winding up of the company. Both these rights are going to go away if you convert the preference shares into equity shares. So it's also a relinquishment. So that's why originally, now the law has been ensuring that it is not a transfer, but the terminal redemption of preference shares is treated as transfer, forfeiture is treated as transfer, relinquishment takes place when the person withdraws himself from the property. You are exchanging assets. Yeah, you are not relinquishing. There you are exchanging. Transfer includes and shall deem to have always included disposing of or parting of an asset or interest therein, or creating any interest in any asset whatsoever manner, either directly, indirectly, absolutely, conditionally, voluntarily, involuntarily. We will come to Vodafone case in the international taxation. Tirpi, we have a problem there. Okay, so we will come to that. That's why that statement. Now, transactions not considered as transfer. Transactions not considered as transfer. What are all the transactions which will not be taxable? Because to come under this chapter, two conditions needs to be fulfilled. It should be an asset. We saw what is a capital asset, what is not a capital asset. We just saw what is transfer. We are going to do what is not transfer. Approximately there are 25 to 30 items, transactions not considered as transfer, and we know what is important and how to understand it. Let's first understand it, then I will tell you how to understand it. Gift or inheritance is not a transfer. If I gift a property, it is not a transfer. Of course, the receiver is going to be taxable under IFOS. Only donor is getting the benefit here. The receiver is going to be taxable. Conversion of, this is what I said, conversion of bonds and debentures into shares and preference shares. So it is not regarded as transfer, but if you ask me whether it is transfer, yes. But they give you some specific exception. I will not tax that transaction. Transfer of specified asset to government or so if you have an archaeological work and you transfer it to the government or to the museum, it is not. Land of sick industrial undertaking, redemption of gold bands, transfer in a scheme of reverse mortgage. Transfer in a scheme of reverse mortgage. What is reverse mortgage? It is a scheme for the senior citizens. Please understand what is a reverse mortgage. It is a scheme for the senior citizens, my dear friends, who are having their own property. What they do is they mortgage the property with the bank, and the bank funds them to the extent of 60%, either lump sum or monthly installments. Either as one lump sum or monthly installments the bank will give you, and the bank will every 5 years once will revalue the assets and accordingly increase the contribution, so that the senior citizens who does not have a fixed source of income, they get that income. On death of the senior citizen, the bank will take over the property, sell the property, take back their loan, and whatever is the balance will be provided to the legal heir. Now I mortgage the property. The senior citizen mortgages the property and gets a lump sum or monthly installments. Both are not taxable. Not regarded as transfer. Reverse mortgage is not regarded as transfer. No capital gains. That is not an income. Section 10 subsection 43 says that is not an income also in the hands of the senior citizen. Later, when the bank sells the property, that time the bank pays the capital gains tax. Okay, when the law uses the term alienation of the property, that is, the senior citizen is no more owning the property; it has gone to the bank. The bank in turn sells. That is the time capital. Is a scheme by which senior citizen mortgages house to a bank or financial institution for a lump sum or periodical payment. Up to 60% of the property is provided as loan. On death of the mortgager, the bank or institution will sell the property, recover the loan, and pay the balance to legal heir. Okay, right? In this, you need to remember gift or inheritance is not a transfer. Whole class we will concentrate. Reverse mortgage is not a and conversions are not. Okay, I have split the entire things into smaller drops for you to remember easily. Okay. Second is due to closure of business. Partition, liquidation. What are all the various types of closure of business? Death of the individual. Automatically it goes to the legal heir, whatever property. Inheritance is not a transfer. So, adu utterla. Dissolution of firm, I will tax. Dissolution of AOP BOI, I will tax. Dissolution of a trust, I will tax 115 TD. We will see that when we do trust, I will tax. Liquidation of a company and distribution to members. That's the rarest event. First, you have to understand. If a company is able to liquidate, pay all the secured, unsecured creditors, and still have surplus and pay to the members, then the company would not have got liquidated. Okay, right. Liquidation of a company paying to members is not taxable, is not transfer under section 46 for the company. For the member, it is taxable because he is surrendering shares, getting money. He is surrendering shares, getting money. So for the member, it becomes taxable. Yeah, balance amount that is distributed to the members. Members are equity shareholders. So transfer of capital asset to members on liquidation. However, this is taxable in the hands of the member. So only partition, it is not taxable. You have to remember at the time of partition of HUF, if the property is given, it is not a taxable. Once you become finance minister, you can leave. As of now, the law taxes the member. Okay. Holding and subsidiary. Remember, my dear friends.
Sir, video is stuck.
Video stuck. Yeah. Next is holding subsidiary. Any transfer by a holding company to 100% subsidiary company or vice versa. 100% subsidiary to holding company will not be regarded as transfer. Okay, provided the transferee company, the receiving company is an Indian company. In the future, we will work out a question, Neptune. The transferee company will be a foreign company, 100% foreign subsidiary. Then it is taxable. Okay, transfer of capital asset by holding company to 100% subsidiary company or vice versa, provided the transferee is also an Indian company, then only this exemption is. Then only this exemption is. Okay, right? Are you clear? Holding company transfers asset to subsidiary company, my dear friends. Holding company transfers asset to subsidiary company. At what price subsidiary company can record that? Arm's length price. Book value of the transferor company. We saw in the previous chapter, section 43. We saw in the previous chapter, section 43, holding subsidiary, amalgamation, demerger. In all these cases, the receiving company, transferee entity, can record the asset only in the value prevailing in the books of transferor. Can record the asset only in the value. You have sealed it there that I cannot take it over in a different value. Now coming and telling me, this is not a transfer, is nothing big. Sir, I cannot make gain, sir. Friends, I cannot make gain. I have a book value asset of 5 lakhs. I transferred to my subsidiary company for 7 lakhs. I accept there is gain. But what you are telling, subsidiary company cannot record the value at 7 lakhs. They can only record the value at 5 lakhs. So when there is no possibility of additional value, there is no gain possible. When there is no gain possible, you just say for namesake, 25 items I am giving you exception. Where there is no gain possible. Okay. So transfer, and the receiver should hold it for 8 years. Okay. And this note, remember, if the transferee company is a foreign company, then this exemption is not applicable.
Sir, screen is stuck again, sir.
Huh?
Screen is stuck again, sir.
Sir, I think she should check her net connection, sir. It's proper only, sir.
Her internet only, sir.
Yeah.
Okay.
It's proper only.
Yeah. Can you please check your internet connection, friend? I think.
Yes, sir.
Others. Okay. Now comes a list of amalgamation they give. List of amalgamation. Transfer of a capital asset in a scheme of amalgamation. We know. Okay. X Limited amalgamates with Y Limited. Obviously, Y Limited will take over all the assets of X Limited. So it is transfer. Transfer of capital asset in a scheme of amalgamation of banks. Cooperative bank. Okay. So if you see 25 items actually, okay, all these things. And now I will tell you all these 3 things into 2. Why I am 2? Because for a shareholder, now the provision will come. If I am a shareholder of the amalgamating company, that is transferor company, I need to surrender my shares and get the shares of transferee company. Y Limited allots to the members of X Limited 3 shares for every 5 shares held by them. So I am a transferor, I am a shareholder of transferor company. There is an exchange taking place. I surrender the shares of X Limited and get the shares of Y Limited because X Limited has amalgamated with Y Limited. It is not regarded as transfer. So for the company also not taxable. For the shareholder also not taxable. Allotment of shares by transferee company to the members of transferor company. Allotment of shares by the predecessor cooperative society. Transfer to the members of predecessor cooperative society. Okay. Last point, only in business trust you will be able to understand. What is this SPV? How the business trust, etc. You will be able to understand the last point. Now hold it. I'll explain you at that time. So all types of amalgamation, here I am only talking about Indian companies. Later I will come to foreign companies, are not taxable. So the areas I have covered is general. In that I asked you to remember gift or inheritance, reverse mortgage, conversion of instrument to instrument. In terms of winding up or closure of business, liquidation only for the company and partition. Holding subsidiary transactions are not transferred provided the transferee is an Indian company. All types of amalgamations are not regarded as transfer in both for the entity as well as the individual shareholder. The opposite terminology of amalgamation is demerger. That is also okay. Splitting up of units. I have two units. I have a hardware division, software division. I split my software division into a new company. I split my software division into a new company. The original company is known as the demerging company, and the new company is known as the resultant company. The original company is known as the demerging company. The new company is known as the resultant company. Transfer of capital asset in a scheme of demerger by the demerging company to the resultant company. Similarly, shares issue. Okay. Demerger is also not a transfer. The most interesting questions are 6 and 7. That is conversion of firm or AOP into company. Majority of the time, firm into a company. So we saw Pushpak and Co in the depreciation, proportionate depreciation. Okay. Here again, assets can be taken over only at the value prevailing in the books of the transferor. But coming, when will conversion be not regarded as transfer? Please remember the condition. All the assets and liabilities of the firm should be taken over by the company. Consideration should be only allotment of shares, no monetary consideration. Only shares should be allotted. The partners should hold 51% of the share capital of the company at least for a period of 5 years. Don't try to convert and escape and go off, at least for a period of 5 years. Okay. All the assets and liabilities should be taken over. All the partners of the firm should become the shareholders of the company. Partners of the firm do not receive any other consideration or benefit. The partners of big firm become shareholder in the same proportion of their capital accounts. Okay, right? Whatever is their capital account in same proportion. The aggregate of the shareholding in the company of the partners of the firm is not less than 50% of the voting power in the company for a period of 5 years. For a period of 5 years. Okay. When we do assessment of firm, assessment of company, I will repeat this and do questions in this also. As of now, read these conditions once. It is similar to amalgamation in the nature of merger. On transfer, the question is, she's asking shareholders should become in the same proportion. That's what the law says. Is that also for 5 years? No. At the time of transfer, 5 years is 51%. That's not taxable. conversion of a company into LLP. Conversion of a company into LLP. Okay. All assets and liabilities of the company should become the assets and liabilities. All the shareholders will now become partners. Consideration should be only share of profit, should not be anything else. The total turnover or gross receipts in any of the past 3 years should not exceed 60 lakhs. It should be a small company which is converted. Two conditions are mentioned for what is a small company. In the past 3 years, your turnover should not exceed 60 lakhs in any of the year, and your asset value should not be more than 5 crores. And your asset value should not be more than 5 crores. Okay. And other conditions are the same. Other conditions are the same. Okay. The last condition that is very interesting here. No amount is paid, either directly or indirectly, for a period of 3 years from the accumulated profits of the company after the date of conversion. Let's understand what this means. If you pay from the accumulated profits of the company, it is known as dividend. If you pay from the accumulated profits of the company, if profits of the company is distributed to the shareholders, it is known as dividend. Remember this on one side. On the other side, drawings from a firm is not at all an income. Drawings from a firm is not at all an income. So what do? You convert it. Had it been dividend, it would have been taxable in your hands, the recipient's hands. You convert it and withdraw it as drawings. I am not permitting that. Okay? Any accumulated profits should not be withdrawn for a period of 3 years. If you withdraw, I am taxing it. Okay? Right? Instead of partner, put proprietor. That is what is conversion of sole proprietor into a company. Okay? All the assets should be taken over. Sole proprietor not receiving any consideration. He should at least own 50% of voting rights for a period of 5 years. Instead of partner, if you put, okay. As I told you about SPV, I will discuss it in the business trust chapter, pass-through entities chapter. And the last is with regard to what are all applicable for non-residents. Here I will give you a brief idea. In non-residents chapter, we will go for a detailed working. Transfer of capital asset being shares of an Indian company. So imagine a circumstance that a foreign company is holding shares in an Indian company. Friends, please understand. A foreign company is holding shares in an Indian company and they sell that shares, it is taxable normally because income accrues or arises from India, so it is taxable if they sell Indian company share. Okay, in another circumstance, a foreign company holds shares in an Indian company, that foreign company amalgamates with another foreign company. A foreign company holds shares in an Indian company, that foreign company amalgamates with another foreign company. So, in the foreign law, how it will be, all the assets of the transferor company should be taken over by the transferee company. So, the transferee foreign company will also take over the shares of Indian company. Okay. I will not tax it provided two conditions are satisfied. first condition, it should not be taxable in your country, this amalgamation. Wherever it is taking place, what your country does not give, don't expect it from our country. Second, shareholders at least 25% should be there. Transfer of capital asset being shares of an Indian company in a scheme of amalgamation of two foreign companies. Two conditions are at least 25% of the shareholders of the transferor company should become the transferor, and the said transaction is not taxable in the country where it is happening. Similarly, demerger, or any time after amalgamation, it will be demerger. 75% members, and it should not be taxable there. All these things, detail you will understand. Transfer of foreign currency bonds or GDR by one non-resident to another non-resident, okay, is not taxable. RDB, that is rupee denominated bonds, which are issued by RBI, okay. Transfer of specified assets, இது எல்லாமே, all this provision is for units located in international financial service center, which is a forex stock exchange which is there in Gujarat. It's known as Gift City, okay, in Gujarat, okay. There is a for IFSC, okay, like special economic zone. There is something known as International Financial Service Center, okay. Transfer of government securities by a non-resident to another non-resident, conversion of for GDRs. If there is no intermediary means, yeah, but the income accrues or arises from India. If two non-resident transact on an Indian asset, it is taxable in India. Please read through transactions not regarded as transfer. Is there a doubt between liquidation and dissolution? Liquidation is a company terminology. It's a process. The end of it is known as dissolution. The process is known as liquidation. But dissolution is more for non-corporate. Non-resident. It is a bond which has been subscribed in foreign currency. Okay, so why we are giving exemption is foreign currency is coming in. So if that is transferred by one non-resident to another non-resident, it has to go through Indian Stock Exchange or this IFSC. So I am giving that exemption, so that I am motivating them to invest. To look back, two conditions are needed to tax an income under this chapter. One is it should be a capital asset. We all know what is a capital asset, more by understanding what is not a capital asset. Stock in trade is not a capital asset except for foreign institutional investors. Otherwise, stock in trade is not a capital asset. Movable personal assets are not capital asset. In that also, jewelry, work of art, architecture, painting are capital asset. Rural agriculture land is not a capital asset. Land located in a rural area. Gold bonds are not capital assets. Special bearer bonds are not capital assets. So these are not capital asset. Anything other which is used for business or personal purposes is a taxable, is a capital asset. It should be transferred. Transfer is two things. One, they have defined transfer elaborately. It's an inclusive definition. Sale, exchange, relinquishment, conversion of asset into stock in trade, extinguishment of asset, okay, compulsory acquisition, partial possession of things, and that cooperative society members transferring are all capital assets, are all capital assets. I mean, are all transfers. What is not a transfer? How to remember this? We in general category. Remember, gift or inheritance is not a transfer, reverse mortgage is not a transfer, and conversion of instruments are not transfer. Then holding subsidiary transactions, closure of business in that liquidation and partition alone, okay, are not transactions. Amalgamation, all types of amalgamation, both for the entity and for the shareholder are not taxable. Demerger is not taxable. Conversion of entities, firm into company, proprietorship into company, company into LLP provided conditions are satisfied. And for foreign entities, okay, again amalgamation, demerger and conversion of instruments are not transfers. It will become taxable. The question is, if conditions are not fulfilled, like not all assets are taken over, some assets are left behind, it is not at all transfer, it will become taxable. we are next planning to understand what is the classification of capital asset. First, why classification? Why should I classify capital assets? There are two reasons for classifications. One, mode of computation. Second, rate of taxation. In the case of long-term capital asset, I give a benefit called indexation. So, mode of computation. In terms of long-term capital gain, it is taxable under section 112 or 112A. So, rate of taxation. There are two reasons for classifying the assets. One is mode of computation, second is rate of taxation, and there are two classifications, STCA, LTCA. Short-term capital asset, long-term capital asset. With the mind-blowing definition of LTCA is one which is not a STCA. Okay, so STCA is only what is defined in the law. STCA is only what is defined in the law in the case of securities, listed securities, units of equity oriented funds, UTI, zero coupon bonds. Up to 12 months, it is a short-term capital asset. Unlisted shares and immovable property up to 24 months. All other things up to 36 months. Repeating, listed shares, units of equity oriented funds, UTI, zero coupon bonds, up to 12 months STCA. Immovable land, building and unlisted shares, up to 24 months STCA. Any other thing up to 36 months STCA, whatever is not STCA becomes LTCA. Now, the next is how to determine this holding period. The next is how to determine this holding period. Okay, how to determine this holding period. Please understand how to determine. The first and the most important is gift or inheritance. The holding period of the previous owner should also be considered for classifying whether it is a short-term capital asset or long-term capital asset. Friends, I have an asset which is purchased 5 years back. I gift that asset to Hariharan, who is selling within 1 year. First understand, no capital gains for me. Gift or inheritance is not a transfer. So if it is not a transfer, no gain. For Hariharan, who has received it and then subsequently selling it, capital gain arises. What is his cost of acquisition? Cost to the previous owner, that we will come to it little later. Whether it is a short-term capital asset or long-term capital asset, because he received it as gift and within 1 year he is selling it, the law says no. The period of ownership by the previous owner, the period of holding by the previous owner should also be considered. So that 5 years should also be considered. So it is a long-term capital asset. The period of holding of the previous owner should also be considered. The same will be in the case of amalgamation. The same will be in the case of holding subsidiary transaction. Wherever we are going to study about various other things about successions, these will come. Shares acquired through partition, liquidation, dissolution, gift or inheritance. Date of purchase of the previous owner to the actual sale of the present assessee. The present assessee is one who is doing it. Okay, that's fine. Okay, right? Shares held in a company for liquidation, date of acquisition to the date of announcement of liquidation, because after that you cannot transfer the shares. Your right relinquishes there, so they convert. Conversion of a stock in trade into asset. In the last chapter we saw it is a sale. Okay, from the date of conversion to the date of transfer we should compute the period. Shares allotted in a scheme of amalgamation or demerger, previous company's holding period. I am a shareholder of X Limited. X Limited amalgamates with Y Limited. I surrender the shares of X Limited, get Y Limited shares. Please remember, it is not transfer. Subsequently, when I sell the shares of Y Limited, to determine whether it is an STCA or LTCA, holding period of X Limited should also be considered. Holding period of X Limited, shares allotted in a scheme of amalgamation or demerger, period of holding in the preceding entity should also be included. Rights issue is from the date of allotment. Okay, business trust, again we have a chapter where you will understand it in a better manner. Shares allotted to a non-resident on redemption of GDR on the date of making the request. On the date of making the request to convert, from that date I will compute. Equity shares are allotted due to conversion of preference shares, debentures or bonds from the date of allotment of preference shares, debentures, bonds. Sweat equity shares from the date of allotment. Segregated portfolio, again you should wait for to understand what is this. Okay, please read through this table once. Converted into asset is a transfer. Okay, it is taxable under PGBP chapter. Fair market value on the date of conversion will be taken and they will compute the profit. From that date it becomes an asset. How many, what is the period you are going to hold? Okay, all right. So, in this arena, what I have covered, in this unit, what I have covered, friends, what makes an income to taxable under this chapter? It should be a capital asset. It should have been transferred. If these two conditions are satisfied, then it comes under this chapter. We understood what is a capital asset more by understanding what is not a capital asset. We understood both the transfers and transactions not regarded as transfer. The list is easy to remember. You have to just hold yourself as you browse through, you will easily remember. Okay? All types of amalgamations, all types of demerger, foreign companies amalgamation also, okay? Gift inheritance, all types of succession of business, all these things are not going to be transferred. Then the capital asset needs to be classified. The classification is into two, STCA, LTCA. Why to classify? Because the mode of computation is different and the rates of taxation are different. Once you classify, then comes the entire period of holding. Okay, the period of holding is going to be the key factor for classification. 12 months, 24 months, 36 months. Some special cases by which period of holding is determined. I am progressing through some questions before going to the other aspects. Question number 1. Specify whether the said agricultural land is a capital asset or not. Before answering the question, let us recollect. Urban land is taxable, urban agricultural land. Rural agricultural land is not a capital asset, so no taxation, no capital gains. What is a rural agricultural land? Agricultural land located in a rural area. What is rural area? That is not defined. They defined the urban area and said anything other than that is a rural area. How did they define urban area? Based upon the population of municipality and distance. Population 10,000 to 1 lakh. First 2 kilometers is urban. 1 lakh to 10 lakhs. First 6 kilometers is urban. More than 10 lakhs, first 8 kilometers aerially across is known as urban. Anything away is a rural. In that, if there is an agricultural land, it is not taxable. Specify whether the said agricultural land is a capital asset or not. Kamalapuram, shortest distance from the municipality is just 1 kilometer and the population of the municipality is 9,000. Huh? Not a capital asset. Okay. Okay. If the municipality's population is less than 10,000, directly it is a rural area. Starting at 10,000 now. If the municipality's population is less than 10,000, okay, okay, population of the municipality or, okay, municipality is enough, does not exceed 10,000. Hence, the whole area is rural area. Any agri land in that area is not a capital asset. Omalur, 1.5 kilometers, 12,000. Not a capital asset. Population exceeds 10,000 but less than 1 lakh. Up to 2 kilometers, it is only a urban area. Okay. 1.5 kilometers. So it is a capital asset. It is a capital asset. Up to 2 kilometers, it is an urban area. Please understand. Beyond 2 kilometers only, it is a rural area. It is okay. So, Nada Sriram, Omalur, idada, urban area vada.
ஆமா சார், ஏர்போர்ட்ல இருக்கு சார்.
ஆமா.
Sorry, am I audible, sir?
Yeah.
Okay.
இங்க எல்லாரும் சொன்னாங்க ஏர்போர்ட்லாம் இருக்கான்னு எல்லாரும் சொல்லிட்டாங்க. ஆனா திட்டிட்டு இருக்காங்க, என்ன அந்த சோம்பேறி பையன் கிளாஸுக்கு வரதுக்கு என்னவா அப்படின்லாம் திட்டுறாங்க எல்லாரும். அதெல்லாம் கேட்டா உனக்கு மனசு கஷ்டப்படும்.
நாளையில இருந்து நாளை கிளாஸ் இல்ல. ஐயோ,
Sir, actually the airport is in Kamalapuram, sir, not Omalur. Airport is in Kamalapuram, sir.
Okay, airport is in Kamalapuram. Yeah. Next, the overall place is Omalur. So population of the municipality exceeds 10,000 but less than 1 lakh. Okay. Up to 2 kilometers will be treated as urban area. In the given case, 1.5 kilometers. Hence, it is a urban area and the land is a capital asset. It is a capital asset in that case. Kurumani, okay, this is a village near Trichy. Okay, these two are my father's own place. This is my mother's own place. Okay, illati எனக்கு என்னமோ இதெல்லாம் தெரியும்லாம் நினைக்காதீங்க. Okay. Okay, population exceeds 10 lakhs. Population exceeds 10 lakhs. Up to what kilometers it is urban area? 8 kilometers. 1 lakh to 10 lakh da 6. Population exceeds 10 lakhs. Okay. வராது. ஆனா மெட்டீரியல்ல இருக்கு. CA இன்ஸ்டிடியூட் மெட்டீரியல்ல. இல்ல சச்சா. No. That's why I'm answering. Otherwise I would not have answered. Up to 8 kilometers. ஆனா உங்களுக்கு நான் ஈஸியா ஆன்சர் பண்ற மாதிரி தான் எஸ் நோக்கு தான் கொடுத்திருக்கேன். Up to 8 kilometers will be treated as urban area. In the given case, it is just 2 kilometers. Srivanjiyam, Sriram saroda urudu. Okay. 8 kilometers, 10,50,000. Exact 8 kilometers is also urban. Up to 8 kilometers means exact 8 kilometers is also an urban area. The last case, it's a rural area. Am I clear? Okay. Question number 2. M held 2000 shares in a company. This company amalgamated with another company during the previous year. Under the scheme of amalgamation, M was allotted 1000 shares in the new company. The market value of the shares allotted is higher by 50,000 than the value of ABC, the previous company. AO proposes to treat the transaction as exchange and to tax the 50,000 as gain. AO நாலே தப்பா இருக்கணும். Okay? Right? AOக்கு லாவே தெரியாது. நிஜமா
முடிஞ்ச வரைக்கும் தப்பா பண்ணணும்.
Question number 2. Yeah, it is not a transfer. Sorry, this I lost that. It is not a transfer. Allotment of shares by transferee company to the members of transferor company in a scheme of amalgamation is not regarded as transfer. Allotment of shares by the transferee company to the members of transferor company in a scheme of amalgamation is not regarded as transfer. Hence, capital gain does not arise. Yeah, you want the answer? Sorry. Let me வச்சிருக்கேன். Then, question number 3. Mr. Abhishek, a senior citizen, mortgaged his residential house with a bank under a notified reverse mortgage scheme. He was getting loan from bank in monthly installments. Mr. Abhishek did not repay the loan on maturity and hence gave possession of the house to the bank to discharge the loan. How will the treatment of LTCG on such reverse mortgage transaction? How will be the treatment? This is not a transfer. So, a scheme by which senior citizen transfers house, mortgage house for immediate, that is lump sum, or deferred benefit, that is installments, is not a transfer. Hence, capital gain does not arise. Okay, I also write one more answer. The money received is not taxable in the hands of the senior citizen. This is there in section 10, subsection 43. Okay, capital gain will only arise to the bank, okay, on transfer of such mortgaged property. Yeah, it is. Yeah, for the bank, they got it as mortgage, cost of the previous owner. So, yeah, the first mortgage scheme should be notified. Okay, there is only one scheme they have notified, and all banks can abide by that. Other than the 60% funding, every 5 years revaluation and all comes.
Just one question. So it's only on house property, right? And no other
Land and
property.
building, both the land
Oh.
and building.
So in the example, I think it was mentioned just house.
Yeah, house means land and building opportunity.
Yeah, that's why I had the doubt.
Yeah, no problem. Land and building, both are. Question number 4. Mr. X had a leasehold property since 5th May 2018. The leasehold rights were converted into freehold right on 20th May 21. The property was sold on 10th January 22. Assessee claimed LTCG. AO contended that the same is a short term as the property was acquired by converting the leasehold into freehold only in May 21. Long term. Why? Okay. Okay. Long term, because leasehold period should also be considered, is Ananya's answer, because I was all along worried that long term, because AO is wrong, நீங்க சொல்றீங்களா? Okay. Yeah, it is a long term capital asset. I will tell you why. Conversion of leasehold right into freehold right is just an improvement and not an acquisition. Okay, it has been established in law that conversion of leasehold into freehold, the date you get the leasehold right, you become the deemed owner of the property. Even yesterday we saw in a question, the building of 20 years they demolished and a new building was put up by September 21. We added back 10 lakhs and provided 1 lakh depreciation, because once you get the leasehold right for a longer period, you get the deemed ownership of the property. They say on payment of some money, you will get the leasehold right into freehold right. I paid it. That is just improvement. Conversion of leasehold into freehold is just an improvement. For computing or for classification, date of allotment of leasehold right should only be taken, not from the date of conversion into freehold. Okay. So conversion, you can only take it from the year of date of leasehold, right? So in this case, it is a long term. It got it in 2018 and held it up to 2022. So it is a long term asset. Am I clear to you? Okay. Right. Yeah. The next arena of our focus, the next unit of our focus is how to compute. Okay, having known what is STCA, LTCA, we are now moving into how to compute this capital gains, or what is that you are saying the mode of computation is different for depending upon the nature. So unit 2 speaks about how to compute capital gains. Full value of consideration minus cost of transfer gives me net consideration minus the purchase price and any capital expenditure after purchase gives me, if it is a short-term capital asset, it will be short-term capital gain. If it is a long-term capital asset, it will be a long-term capital gain. But what is the difference? The difference lies here. It is indexed cost of acquisition, indexed cost of improvement. Okay. In the case of others, it is just cost of acquisition, cost of improvement. Here it is indexed cost of acquisition, indexed cost of improvement. Okay. That is the difference. Okay. Right. Let us understand every terminology so that we have to understand if it is a STCA, the result is STCG. I have written the positive terminology. It can also be loss. Okay. If it is LTCA, let's understand every terminology. What is full value of consideration? The sale consideration arising from transfer of asset. Money received or receivable when the asset is transferred, and that is simple. There are enough cases to say, apart from sale consideration, what can be regarded as full value of consideration? We call this as deemed value, deemed FVC, deemed full value of consideration. In the case of destroyal of an asset, I am not selling. The asset is destroyed. He was asking me, what is full value of consideration? Insurance compensation received. I again tell you, all these cases I'm going to work out and show you. Okay. Once, twice, thrice, if I am able to tell it again and again, okay, preparation time becomes lesser, and you are able to retain it in your memory. You are able to understand it better. Okay. Again, a small deviation. Okay. In my opinion, whatever you read, you should tell it once, so that it is retained. Not 5 times reading doesn't improve your memory. If you share it, you will be able to retain it better. You will be able to, whatever you read it, okay, depreciation. How to compute my normal, additional, what are all the conditions for additional, specified business, what are all the things which I should remember for specific. You should share it. The best person to share is your mother. The best person to share. Okay. The most wrong person to share is your friend. Okay. Why? Yeah, I'll tell you. For friends are not for subjects. Okay, not for sharing subjects related. The subject related knowledge, a friend who is also doing the same subject, when you are going to share with them, நீ இந்த பாயிண்ட விட்டுட்ட அப்படின்னு தான் வரும் 90% of the time. அவனுக்கு அந்த பாயிண்ட் மாத்திரமே கூட தெரிஞ்சிருக்கலாம். But still he'll say, but your mother is one who will feel very proud whatever you say, even if entire thing is wrong. So the best person to share in your preparation process is always your mother, because you will get lot of positive energy when you talk to her, when you share with her. Okay, especially in a dining table, when you are having dinner, lunch, if you ask her to sit and share, that proportionate depreciation means I should split based upon effective usage. Okay, if this is a friend, they will say, no, nee period effective usage period pona moodevi அப்படினு இருக்கும் நமக்கு. But still okay, but for your mother, she will listen. So I would recommend you to share whatever we are reading. That's why I am repeating it 3 or 4 times. Thank you, Sudha. Okay, I will repeat, okay, 3 or 4 times, because only you will understand that it is her happiness that will come out to you, and she will be very happy that you are speaking some high knowledge. Neenga onnum pesalendradhu only your friend and me knows. Okay, amongst the chartered accountant matram outside world, oh, you are a CA adu idunu two chartered CA va. Okay, so pambariyum pambin kal. Okay, so please understand, these are some of the things which you can follow. Coming back, so why I am repeating is your sharing will be really enjoyable when you do that. Okay, second, conversion of asset into stock in trade. I am not selling anything. It's a book entry which is getting passed. It is a book entry which is getting passed. FMV on the date of conversion. Fair market value on the date of conversion will be treated as full value of consideration. FMV on the date of conversion. Introduction of capital asset by a partner. Book entry. Okay, a partner brings in asset account debit to partner's capital account. This is the entry. Okay, value recorded in books. Value recorded in books. Compulsory acquisition. Government taking over. Whatever compensation is paid by the government. Whatever compensation is paid by the government will become full value of consideration. Okay, you are having a land and building, or you are having a land, whatever, land or land and building, whatever it is. A developer comes to you and says, why are you having independent house property? It is difficult to maintain. So let us destruct this property and construct some 4 floors, construct as 15 apartments. I will allot to you 2 or 3 apartments, plus I will pay you monetary consideration. We call this as specified agreement. What is specified agreement? Where the owner and the developer enter into an agreement for development of the property. The owner will get some undivided land area, some house property, and monetary consideration. All these I will work out, don't worry. Okay, all these things, not that I'm just doing it twice or thrice so that you are getting registered. Stamp value of land and building on the date of completion certificate plus monetary consideration will be full value of consideration. In short, fair market value of property allotted plus money consideration. Fair market value for immovable property, majority of the time they will only take stamp value and not FMV. Liquidation of company, we already know it is only to the shareholder it is taxable, not for the company. For company it is not a transfer, it is not taxable. Only for the shareholder it is taxable. Fair market value on the date of distribution plus monetary consideration minus deemed dividend. You will understand these things. 50C, transfer of immovable property. actual consideration or stamp value, whichever is higher. Okay, actual consideration or stamp value, whichever is higher. In our colloquial language, we use a terminology. Here and there, 10%. Now it is given a legal significance itself. The law says if the stamp value does not exceed by 10%, 110%, then no problem. Take the actual consideration itself. 1 lakh is the actual consideration. 1,02,000 is the stamp value on the 2,000. It's a small amount in a transaction. Okay, ignore that. Take 1 lakh. That's why it says, however, where the stamp value does not exceed 110%, then actual consideration will be taken. 50 CA is for unlisted shares, actual consideration or FMV on the date of transfer, whichever is higher. So friends, the terminology full value of consideration is normally sale consideration, but not all circumstances. In various circumstances, this will change. In various circumstances, this will change depending upon the nature of transaction. Am I clear to you? Okay. Next is cost in the explanation. In the format which we are understanding, the next item is cost of transfer. Abdina? Stamp duty, legal charges, etc. Expenses incurred for transfer. One more time, one more way of putting it. But for this expenditure, transfer would not have taken place. Stamp duty, brokerage, commission, okay, all these things you know right from your inter-level itself. Okay, final one, extra or 1 or 2 தெரிஞ்சுக்கணும். Let final நம்ம நம்ப மாட்டோம். Okay, right, it is okay sir, final capital gain, finally it's capital gain only sir, same formula only na நம்ப மாட்டாங்க. Okay, I have been facing these problems. Okay, couple of days back, one of our students of CMA friends asked, sir, when will you take income tax for CMA? Hey, income tax for India. Income tax is not for CMA, CA and all. Everything is the same only. So coming back. But for this expenditure, the transfer would not have taken place. See, tenancy right. That is a. Let us take, I have given a house property on a 10-year lease to a person. At the end of the 3rd year, I want to sell the house property. The purchaser said, ask me, vacate, ask the person to vacate, then one day I will buy the property. So I go and approach him saying, boss, I want to sell the property, can you vacate? He says, pay me this money for vacating because I am going to terminate my lease contract, my right, so pay me this money. Unless I pay him that money, he will not vacate. Unless he vacates, I cannot sell. So this will become cost of transfer. இப்ப இருக்கிற most popular cost of transfer, stamp duty இதோ இல்ல, cost of travel. Property is owned by a non-resident or he was a resident. He went and settled outside India. He is coming here exclusively for selling the property. He has found the buyer through online channels. He has negotiated everything. The registration is going to happen. He is traveling exclusively for the purpose of selling off this property. Cost of transfer. This is one other case you have to concentrate and understand. Mr. X has mortgaged the property, not reverse mortgage, mortgaged the property. Mr. X dies, his son Mr. Y takes over the property. He discharges the mortgage and then sells the property. Unless the mortgage is discharged, You cannot sell the property. Unless the mortgage is discharged, you cannot sell the property. The discharge charges paid will be treated as cost of transfer, or if it is paid for preceding years, now only transferring, you can even index it. Okay. I'm again repeating all of you. Charges paid for discharge of mortgage, cost of transfer are, you cannot answer yes or no. No. If it is by the same person who has mortgaged the property, it is not cost of transfer. Only if it is by the successor of the property, it is treated as mortgage. It is treated as expenses. Remember, any compensation paid for vacating the property, mortgage charges paid by the successor. For example, on death of the assessee, his son paid. Remember, mortgage charges paid by the successor will only qualify. Where the assessee himself incurs, then it will not be concerned. Okay. Any charges paid for clear title and security transaction tax will never be allowed as deduction, because I'm going to give them a shorter tax rate. STCG na 15%, LTCG na 10%. I'm going to give a smaller tax rate, so it will not be allowed. See, you got the loan by mortgage, you enjoyed the loan. So you clearing the mortgage is not a big event at all. Only the person who has not got benefited is the successor. Predecessor got the loan, he did not pay it. The successor, that's why only for the successor, not for the original mortgager. Yeah, in tax, the original mortgager will not get the benefit. So cost of transfer, little more elaborately understand, any expenses incurred, but for this expenditure, you would not have been able to transfer the property. It is known as cost of transfer. Uh, still they can claim. I understand your question, but still they can claim. I cannot close all the doors here in tax. Still, the successor, even though he has enjoyed the money, can claim the discharge of mortgage. In this case, yes, successor means inheritor. Yeah, you cannot gift a mortgaged property also unless you release the encumbrances, etc. The free transfer will not take place. That is selling. I'm saying you can sell a mortgage property, get the money, settle it. You cannot gift them free of encumbrance. Next, in the format FVC, cost of transfer, you get net consideration. Next is cost of acquisition. Simply to start, purchase price of the property, and any expenses incurred at the time of purchase will be cost of acquisition, and that's not it is. There are many cases like deemed full value of consideration. There is deemed cost of acquisition also. Okay. If the asset is purchased before 1st April 2001, you will wonder why this date significant. Because for indexation, the base year is 2001-2. For indexation, the base year is 2001-2. That's why it is significant. Either actual cost or fair market value whichever is higher, but the fair market value cannot be more than stamp value. Okay, I told you for immovable property, stamp value is the major value. So fair market value should not exceed. It is a last year amendment, not your year, immediate preceding, it has amended. Asset acquired through gift, inheritance, partition, all types of succession, firm converted into company, company converted into LLP, proprietor converted into company, amalgamation, demerger, amalgamation of foreign companies, shares allotted in a scheme of amalgamation, shares allotted in a scheme of demerger. In all these cases, cost of the previous owner or cost of the previous asset. In all these cases, cost of the previous owner, or you can see under that cost of the transfer or entity. For everything, succession, amalgamation, demerger, cost of the previous entity. Okay. Conversion of GDRs into shares, fair market value on the date of placing the requisition. We will see that in international taxation. In case of additional compensation, you can only claim legal charges. You cannot claim any cost of acquisition. Similarly, for self-generated goodwill, etc. Conversion of debentures or preference shares into shares, cost of debentures or preference shares. Okay. Depreciable asset, we all know, opening WDV plus addition. Slum sales net worth. Okay. Slowly you will be able to understand. As I promise you, we will be doing in all these things questions. We will be doing in all these things. Everything will become a separate unit of understanding for us. Okay. And when I look into the format, the cost of improvement is capital expenditure incurred after acquiring the property. The only difference between STCA and LTCA is this word called index, but it's a huge difference. Indexation is the inflationary benefit, is the inflationary impact prevailing in the economy. Indexation is the inflationary impact prevailing in the economy. So they bring the money value to present value, the past money value to present value and compare. Government announced the inflation, okay? So you will understand that the inflation will be much lesser than the market-oriented inflation, okay? The base year is 2001-2. The base value is 100, okay? Right? So 100 is the base year, and now it is 317. That is 100 rupees of 2001-2 is worth 317 rupees today. Is worth 317 rupees today, but in real scale it will be some 650, 700 rupees. Okay, only if they include petrol itself, it's enough. Indexation will go from the by hundreds every year. Okay, so 100 become 317. So this is the base year and this is the current year. Even if you are jobless, don't buy hard this and all. They give it to you in the examination, the indexation, entire indexation values. So don't worry. Okay, so in our format of computation, okay, the whole point is how to take full value of consideration. Less cost of transfer gives us net consideration. Less cost of acquisition, cost of improvement if it is a short-term capital asset. Indexed cost of acquisition, indexed cost of improvement if it is a long-term capital asset. Giving you gross STCG, gross LTCG as the case may be. Yeah. 25, 30 years later, they will 1981-82 was the base year, and then they changed in 2014-15 as 2001-2, so it will keep changing. Read through once unit 2. From unit 3, we are going into practically every particular case. You will, for introduction of capital asset by the partner, value recorded in the books. That is, in the firm's book, they will put asset account debit to partner's capital account, that value. Security transaction tax, why it is not allowed as an expenditure? When you sell shares, you pay that. Why it is not allowed as expenditure is, the rates of taxation is different for them. It is 15% and 10% STCG and LTCG, not 30 and 20 as it used to be. So, since I am giving them a benefit, I am not giving the tax deduction. Shall we? Formula for indexed cost of acquisition is cost of acquisition, either direct or deemed, into CII of the year of transfer. Majority of the time, not all the time, majority of the time this will be 317 for you, the numerator, and denominator CII of the year in which asset was first held by the assessee. I'll talk about this. Indexed cost of improvement, numerator year of transfer, denominator year of improvement. Improvement before 1/4/2001 should be ignored, okay, because we are taking fair market value. Benefit of indexation is not available for SDCG, depreciable asset, slum sales, bonds and debentures, non-residents who are going to have a concessional rate of taxation. Case by case we are going to take. First set of cases, special cases I'm going to take is asset acquired before 1/4/2001, gift, inheritance, and this amalgamation like that, succession. Okay, first set of cases like this, case by case wise we are going to go, special case wise. Asset acquired before 1/4/2001. Asset purchased before 1/4/2001. Why this is important? If I have purchased the asset in 95-96 and selling it now, I don't have a denominator because the base year is 2001-2. I don't have a denominator. So what does law says? Had you purchased on 1st April 2001, what would have been the value you would have paid for the asset? Disregard you have purchased it in 95-96. Consider it as if you have purchased on 1st April 2001. On that day, you would have paid some value. So they say for all assets acquired on or before 1/4/2001, COA will be actual cost or fair market value as on 1/4/1, whichever is higher. Consider that you are purchasing the asset on 2001. If the actual is higher, then fine. Otherwise, consider, so that now you will have a denominator 100. Had you purchased on 1st April 2001, you will have a denominator 100. With a clear marking from Finance Act 2020 itself. However, where the asset is land and building, the fair market value should not exceed stamp value, or you should only take stamp value where it exceeds. Once more? In most cases, stamp value is lesser than. Yes. The benefit, yeah. Property acquired through gift or inheritance. Property acquired through gift or inheritance. Is gift or inheritance taxable? No. It is not a transfer. So I gave you an example that I gave Hari gift. Hariharan in turn sold it. For me, it is not taxable. For Hari also, at the time of gifting, depending upon the circumstance, it is different. But when he is subsequently selling, transfer takes place. Capital gain arises. Okay. Capital gain does not arise to the donor. For the receiver, capital gain will arise when it is subsequently sold. Cost of acquisition will be cost of the previous owner, and where I have purchased it before 1/4/2001, go back to the previous case. Okay, right? Please wait. Huh? Previous owner. taxable. Previous owners, previous owner. Gift or inheritance. Okay. So we all know only to the person who is receiving the gift and subsequently selling, taxation arises. Okay. COA will be the cost of previous owner with the same condition. Okay. It will be that is if the previous owner has purchased before 1/4/2001, take the FMV or stamp duty on 1/4/2001. This is cost of acquisition. Okay. Period of holding, how will you count? Okay. Consider previous owner period also. Consider previous owner's holding period also from the to know whether it is a long-term capital asset or short-term capital asset. Consider the previous owner's holding period also. Now, ICOA, indexed cost of acquisition, COA into CII of the year of transfer divided by CII of the year in which, okay, asset was first held by the assessee. Asset was first held by the assessee. Yaar assessee? Receiver. In the given example, I gifted to Hariharan. Hariharan is selling. So assessee is Hariharan. When did Hariharan become the owner of the property? When did Hariharan get the ownership? On the date I gave him the gift only, he became the owner of the property. So the interpretation is ICOA is equal to COA into CII of the year of transfer divided by CII of the year of gift or inheritance. Okay, because the formula is saying CII of the year in which asset was first held by the assessee. Held means ownership. When did the person get the ownership? In the year in which he got the gift, he became the owner of the property. So denominator should be CII of the year of gift or inheritance. This is as per law. Okay. I'm yet to put the case law there, but don't worry. When you get the material, you will get it. Manjula J. Shah and Arun Shunglu Trust. Rendu famous case law. Okay. Manjula J. Shah da ellarme quote பண்ணுவாங்க. Okay. This is Bombay High Court. Okay. This is Delhi High Court. Both had a judgment. Okay, both in both the cases the judgment was the same. Okay, when you consider cost of previous owner, when you consider holding period of previous owner, you should also consider the indexation of the previous owner. Okay, so it is divided by, they said it is divided by original cost of acquisition, I mean CII of the year of acquisition, or 100 if it has been purchased before that, or 100. This is not a Supreme Court judgment. This is a High Court judgment. Doesn't apply generally to all other. But across the nation, everybody started following it because assessee friendly judgment. Across the nation, everybody started following it. The judgment came long back. Finance Ministry is yet to clarify which one they want to follow. They are yet to clarify. In the practical world, people started taking the benefit, taking the beneficiary provision. So they are taking. Finance ministry is silent. Who is the ultimate sufferer? Students. Why you have to give two answers? You have to now, for every question of gift, inheritance, etc., you need to give two answers, my dear friend. Answer number one, as per law, asset first held by the assessee. Answer number two, applying the provisions of Manjula Desha case. Our institute material suggested answers as per act. Then note. However, there is a case law of Manjula Desha where it is held when the previous owner's cost of acquisition is considered, holding period is considered, we should also consider the indexation benefit available to the previous owner. So the answer will be, in every question we are going to do this. As per act, it is first held by the assessee. As per Manjula Desha, it is ICOA is equal to COA into CII of the year of transfer divided by CII of the year of original acquisition, or 100. Huh? Yeah, இல்லைனாலும் போடணும். I mean, even if you are in Chennai, people here have started taking the benefit. I am very much aware of it. So two answers we are going to do. In lot of questions, we need to work out two answers. The correct interpretation, I think Manjula Desha we should hold good, especially for inheritance. Yeah, it was never meant to be. Gift, very rarely people will try to use it as an option of tax saving, but that can be avoided. So I think the judgment will be held valid, but not yet clear. So the judgment is neither fully favoring the assessee nor fully detrimental to the finance ministry. Only the students community, not even I will say community at large. Other institutes have changed, divided by Manjula Desha, but our institute is very clear, which is what is right. The act has not been amended. This is just a high court judgment, so we give two answers. Say there is always something known as I understand jurisdiction of high court is restricted to the assessees of that, but if it goes to court of law, no, Madras High Court, they will say, see, a similar judgment is there in Bombay High Court, so give that benefit here also. The assessing officer can disallow, then they will go on an appeal, and in the appeal they can quote. That's why they take that benefit. Otherwise, applicability, I agree with you. Question number 5. Very patiently we need to work out this question. After a very, very long time, you are all going to work out cost of acquisition, index cost of acquisition using calculators. Okay, there is no that simple tax etc. softwares here where you have to just feed in numbers. So take your time, but understand it fully. Aruna received a diamond ring from her uncle on her wedding on 16th June 2013. Her uncle had purchased it in 910 for 51,000. The fair market value on the date of gift. That is never useful information for us. Previous owners only we need. Aruna's father died on 23rd December 2020, leaving behind his house, shares and land to Aruna. The house was purchased in the year 1995 for 2,40,000. Fair market value of the house on 1st April is 410, whereas stamp value is 380. And additions were made in 2007-8 for 6,70,000. The shares were invested in 11-10-12 for a total value of 84,000. The land was purchased in the outskirts of Chennai and the registered document of 11th January 2020, the value recorded is 5 lakhs. Aruna decided to sell off all these assets during the previous year. Diamond ring, house, unlisted shares and land. She had to clear mortgage of house property by paying 40,000 final installment. Brokerage paid on shares 2% and on land 3%. Compute the capital gain arising in the above transaction. Read through the question once. If you have read through the question, one thing I want you to mark, hope you have noted, this is a short-term capital asset, 11th January 20, 7th January 22. 11th January for land, it's a short-term, 2 years, immovable property up to 24 months. 2 years is short-term. Purchased on 11th January 2020, sold on 7th January 2022. That is a short term. We'll work out it in a separate table. Other things we will start working. Okay. Please write on top computation of capital gain as per the provisions of law. Computation of capital gains as per the provisions of law. 2014. You don't have it in India. Yeah. Case laws are not applicable for it. மெமரி ஸ்ட்ராங்னு காமிக்கிறேன் நமக்கு வேற ஒன்றும் இல்லை இல்லை இருக்கட்டும் பரவாயில்ல நான் திருப்பி கேட்பேன் இன்டர்ல சொல்லி கொடுத்ததெல்லாம் அப்ப ஏதாவது காது திருக்கிடுவேன் cost of transfer. The question says she had to clear a mortgage of 40,000 for house property, which is only cost of transfer because she is an inheritor of the property, and 2% for shares. reference ICOA. We are working out as per law. So the formula, okay, will be COA into year of transfer divided by year in which asset was first held by the assessee. Remember that we are going, assessee is Aruna now. Assessee is Aruna now. So let me go for diamond ring. Let me go for diamond ring. Okay. Aruna received a diamond ring from her uncle on 16th June 2013. Rajana, ipo receiving a pathi, subsequently she has sold it. I am in capital gain. I understand the wedding, on the occasion of wedding, the gift is not is taxable for Aruna in 2013-14. This would not have been taxable. Okay, I also appreciate your strong knowledge, or I appreciate your knowledge that on wedding you can receive gift. Okay, okay, or life planning oda pakran. Okay, okay. Her uncle had purchased it for 2009-10 for 51,000. Okay, so 51,000 into 317. Please have the indexation page with you for easy reference. Okay, 317 divided by year in which she got it as a gift. Year in which she got it as a gift, 16th June 2013, which is nothing but 1314. For 1314, the index value is 220. 220. Okay, 220 year of gift. Okay, so 51,000 into 317 divided by 220. Okay, house property பொறுத்தவரைக்கும், that house property is purchased by her father before 1/4/2001. Before 1/4/2001. Actual acquisition or fair market value as on 1/4/2001, whichever is higher. However, the fair market value cannot exceed stamp value. Having this in our mind, okay, on 23rd December 20, the house was purchased in 1995 for 240, whereas the fair market value as on 1/4/2001 410, but the stamp value is only 380. So I can only take 3,80,000. I can only take 3,80,000. Okay, write a small note. Okay, for house. Okay, FMV cannot exceed stamp value. Hence, stamp value on 1/4/2001 is considered. Okay, now coming to that, it comes to 3,80,000. 3,80,000 into 317 divided by 100. Are we clear? Divided by the year in which she inherited the property. Divided by 2021. Her father died on December 20. Okay, so 2021, which is 301. Okay, which is 301. Okay, divided by 301 year of inheritance. I'll come to improvement later. I'll complete the unlisted shares also. Okay. Unlisted shares. Okay. The shares were invested in 1112 for 84,000. 84,000 into 317 divided by 301 year of inheritance. Improvement happened in 2007-8, 6,70,000 into 317. Interestingly, here it is not first held by the associate and all. Year of improvement. Improvement happened in 2007-8. 2007-8, 129. Because the law has not said divided by the year in which the improvement are first held by the C. The law has just said CIA of the year of improvement. So we take the favorable interpretation. Are we clear? Are we clear? I'm getting 266, 514 friends, 225, 83, 867, and 168, 295. I'm working for land now. I'm working for land, which is a short-term capital asset. Okay. Full value of consideration is 18 lakhs. Cost of transfer 3% of 18 lakhs. 3% of 18 lakhs. Okay, it is 5 lakhs. So I'm getting a short term capital gain. Short term capital gain of 12,46,000.
Sir, could you scroll up just a minute
Yeah,
before
sure,
the
sure,
gate?
sure, friend, sure. Now I am going to Manjula Jesha provision. Okay, Manjula Jesha. Okay, judgment. Okay, please write the judgment. Okay, when the cost of previous owner is considered, when the holding period of the previous owner is considered, then indexation benefit available to the previous owner should also be considered. When cost of the previous owner is considered, holding period of the previous owner is considered, indexation benefit should also be considered. Start your answer with net consideration, all of you. Start your answer with net consideration as per Manjula J. Shah judgment. Okay. Start from net consideration. Net consideration is 340, 4630, and 256 760. Start with net consideration. Okay. 340, 4630, and 256 760. Now, let's go to the diamond rings case. Aruna received a diamond ring from her uncle. Her uncle had purchased it in 2009-10 for 51,000. So, 51,000 into 317 by 2009-10, which is 148. Okay, 148. Nothing but 2009-10's indexation. So it will be 148. It will be 148. Here it will be 100. It will be 100 because base year, since it is purchased, okay, before we should take the base year. So here it should be 100. Here it will be 100. Take your time and work out. Take your time and work out. For shares, it will be 11, 12. Hello? Take your time. No rushing up. You can take your time and work out. Write neatly what is the indexation value. The assessee will be benefited. That's why I said that this is being followed everywhere.
சார் இந்த ரோ நம்பர் 60ல டினாமினேட்டர்ல அந்த வேர்டிங் சேஞ்ச் பண்ணும்.
Thanks. Okay. Anybody still doing? I can wait. X and Sons HUF purchased the land for 1,20,000 in the previous year 3/4. In 7/8, partition takes place. Mr. A, one of the participant, is allotted this plot valued 150. In 2008-9, he incurred improvement of 235. He sells the property for 15 lakhs in 2001-2. Yeah, go ahead, friends. I want to answer. Anyhow, I don't have the answers ready. Well, I'm also working. Just give me. I'm also working. Just give me some time if you're answering. I'll just check your answer. Paniappan. Yeah, correct, Sriram. Part of the answer only you're given, partly correct. No, on the date of the fair market value on the date of partition is 1,50,000. Yeah, yeah, yeah. Doesn't matter. No. Your cost to the previous owner only matters. Are we clear? Yeah. Question number 7. Xavier had taken a loan under the registered mortgage deed against the house, which was purchased by him on 26/5/93 for 5 lakhs. The said property was inherited by his son Abraham in financial year 1011 by will. So that is the key factor for the denominator as per law. For obtaining a clear title thereof, Abraham paid the outstanding loan amount of 15 lakhs. This will also become since it is paid in the years, you need to index it. If it is paid in the current year, cost of transfer, it is paid in the previous year, so you need to index this 15 lakhs also. You need to index this 15 lakhs also. The said house property was sold for 50 lakhs. Examine with reason the amount chargeable. The stamp value of the property on 1st April is 7 lakhs, whereas the fair market value is only 6,50,000. Go ahead. Cost of improvement, okay, or cost of acquisition, doesn't matter. You can index it. That's what is the key. It won't be cost of transfer. It will be cost of transfer if it is the same year. If it has already been incurred, then the rupee value changes, the benefit will be provided.
Sir, since he is paying for clearing the title, can't we consider this as cost of transfer, sir?
You can consider it, why you should not consider it as cost of transfer is, it is not paid in the current year. It has been paid in the year 1011 itself. So the benefit of indexation, bringing it into the fair value is also there. That's why I have not considered it as cost of transfer.
Though I got the same answer, I wrote it as cost of transfer.
Nothing
And
wrong,
then
because normally cost of transfer doesn't have the indexation benefit. So we
Okay.
don't take that as cost of transfer. Otherwise, fine. That doesn't matter. The nomenclature doesn't matter.
Okay, sir. Thank you, sir.
I stop it here so that we continue on Tuesday morning. Okay. With this type of special cases. Everywhere we'll understand the intricacies and nuances. Meet you again on Tuesday morning. All the best, friends.